Today, we are diving into a stock buying strategy that honestly feels a little bit like a cheat code. It's an approach that some traders use, and it completely flips the script on how you might think about buying shares. Let's get right into it.
So picture this. You've found a company you absolutely love, but the stock price is just a little too high right now. You'd buy it in a heartbeat if it just dropped a few bucks. Okay, now what if you could actually name that lower price and someone would pay you real cash today just for agreeing to buy it at that price if it falls? I know, it sounds a little too good to be true, doesn't it?
Well, it's not a hypothetical. This is a very real strategy that uses financial tools called options. It lets you generate income while you patiently wait for a stock you want to hit the price you want. So how on earth does this actually work?
The entire strategy, the whole shebang, is built on one specific type of options contract. It is the absolute key that unlocks this entire concept, and it's called a put option.
Okay, so before we jump into the strategy itself, let's make sure we really get a handle on our main tool. What exactly is a put option?
At its core, a put option is just a contract. If you buy a put, you're buying the right, and notice I said right, not obligation, to sell 100 shares of a stock at a price you both agree on beforehand. That's called the strike price. Really, it's just a way to bet that a stock's price is going to go down.
And here is the crucial twist. For this get paid to wait strategy, we are not interested in buying puts at all. We're going to be on the other side of that transaction. We're going to be the ones selling the put option to somebody else. This lays out the difference perfectly. The person who buys the put pays a fee, it's called a premium, to get the right to sell shares. But you, as the seller, you're the one who receives that premium. In exchange for that cash, you take on the obligation to buy 100 shares at that strike price if the stock drops. You're basically selling an insurance policy, and you get paid for it right up front.
Okay, theory is great and all, but let's make this real. The absolute best way to understand this is to just walk through a concrete example from our source material. Let's see how this plays out with a real company and some real numbers.
So our case study is all about the video game company Activision. At the time this trade happened, the stock was trading for about $67 a share. A trader was looking at it and decided, you know what, I want to own Activision, but $67, it's just a little steep for me.
So here's exactly how the trader did it, in 4 simple steps. First, they picked a stock they genuinely wanted to own for the long term, Activision. Second, they chose the price they'd be happy to buy it at, setting their target, their strike price, at $65. Third, they sold a put option with that $65 strike. And finally, the best part, they immediately collected a cash payment, that premium we talked about, from making the deal.
And how much cash are we talking about? $175. Just for making this agreement, $175 was deposited right into their account. Instantly. They were literally getting paid to wait for the stock to maybe, just maybe, drop to the price they wanted to buy it at anyway.
All right, so the trade is on, the money's in the bank. So, what happens next? Well, from here, there's a fork in the road. There are really only 2 simple ways this can go, and it all comes down to where Activision's stock price is when the option contract expires.
This lays out the 2 outcomes perfectly. In scenario 1, if Activision's stock price stays above that $65 target, well, the option expires worthless. The buyer isn't going to use it, you just keep the full $175. Free and clear. In scenario 2, if the price does dip below $65, you fulfill your end of the bargain, you buy 100 shares of Activision at the price you wanted all along.
And here's where that premium really does its magic. Even though you're technically buying the shares at $65 each, that $175 you were paid up front, it basically acts like a discount. Your actual cost per share isn't $65, it's effectively $63.25. You got paid to buy the stock you wanted at a price that's even lower than your original target.
Now, I know what you might be thinking. This sounds like a perfect can't-lose strategy. But in finance, there is no such thing as a free lunch. So, what's the catch? It is so important to understand the risk you're taking on here. And the catch is that word obligation. It's not a suggestion, it's an absolute rock-solid commitment. If the stock price is below your strike price when the option expires, you are required to buy 100 shares at that price. And it doesn't matter if the stock fell just 1 penny below, or if it completely crashed by 50%.
Let's just paint a picture of how this can go wrong. You agreed to buy at $65 a share. But let's imagine some awful news comes out, and Activision stock absolutely plunges to $60. you are still forced to buy it at $65, costing you $6,500 for shares that are now only worth $6,000 on the open market. That's an immediate $500 paper loss. Sure, your $175 premium helps a little, but you're still down big. This is exactly why you should only ever use this strategy on stocks you truly want to own for the long run.
You know, our source material puts it perfectly with this quote: "There is just no substitute for education." Before you even think about trying a strategy like this, you have to understand the mechanics inside and out, both how you make money and, just as importantly, how you can lose it.
So in the end, it's a really powerful tool, but it's definitely not without its dangers. Is it a kind of superpower that lets you generate income while buying stocks at a discount? Or is it more of a high-stakes waiting game where a sudden market drop could leave you holding the bag? Well, the answer, like with most things in investing, depends entirely on your knowledge, your discipline, and frankly, your stomach for risk.